Are you worried that a raise is going to make you pay a ton more in taxes, that your raise won't even be worth it? Well, fear not, because I'm going to explain just how taxes work in today's episode. Welcome, new and returning money buddies. Today's episode is a good one because this is such a common complaint that we weren't taught about taxes in school. It's something that I've heard from all of my peers, and really everyone out there wonders why we weren't taught about taxes in school. While it is true, taxes are one of those areas that's knowingly complex and made complex on purpose so that these big tax companies can make money off of the regular everyday person like us. Tax companies actually lobby for the process to stay complicated so that you can pay them for them being so nice and helping us with our taxes. But I could go on and on and on about this on a 30-minute rant, so I'll stop there so that you can get back to the educational content that you tuned in for today. Today, I'm going to make taxes a little bit less complicated and a whole lot more understandable. Today's episode is going to be great, but so are the episodes that I have in the pipeline. So make sure you subscribe to the show so you don't miss any future episode. But what are we talking about today? Well, today's story is all about how my wife and I were able to take advantage of the tax code with a little bit of knowledge and planning to pay 0% on the money we earned from some investment gains. And this is an awesome strategy that I really bet each and every one of you can take advantage of. Who doesn't love a 0% tax rate? So if you want 0% taxes, make sure you stay tuned throughout today's episode because I'm going to give you some great insights in order to pay 0% on some of your investment gains. In today's research segment, I'm going to tackle some of the main things that are helpful for us to know when it comes to taxes. Like, how do tax brackets work? What's taxable income? What's this AGI abbreviation? What does that even mean? I'll define it for you today. We're going to get into deductions like itemized versus standard. We're going to talk about capital gains when it comes to investing and capital loss harvesting. There's a lot of things that can go in there, and you can actually get some tax benefits both on the gain side or your investment growth and on the loss side if you picked the wrong stock before learning about index funds and now it's down a bunch of money and you don't know what to do with it. Well, I'm going to help you get a tax benefit from that. And then we're going to talk about some common tax mistakes, including one that I have made myself. So make sure you stay tuned throughout the research segment because I'm going to tease out a potential bonus episode that's going to come in a couple months. Today, we're going to bring back the case study approach with some mini case studies into some real life scenarios to help you take away some very actionable insights from today's episode. And of course, please consider sharing it with a fellow money buddy who could use some help understanding the seemingly complex world of taxes. Let's get into today's story about how my wife and I were able to legally pay 0% in taxes. It's not some fancy loophole or fraud. It's something that you could all do this year. So let's get into it. So allow me to paint the picture here. My wife and I, we found ourselves with some pretty solid investment gains over the years, and they were just sitting there. We weren't sure what to do with them. We knew that no gain or loss is real until you realize it, right? It's all just hypothetical gains or hypothetical losses until you actually sell the investment. But then we heard about this great strategy called capital gain harvesting. It's where you use the capital gain tax brackets, which are a special tax bracket, and where you use them in your favor. I'll teach you more about that in the research segment and how you can use the brackets specifically to your advantage. But there is a bracket that allows you to pay 0% taxes on long-term capital gains, which is great. Now, what is a long-term capital gain? Well, that is when you sell an investment that you've had for over 1 year. And when you've had it for over 1 year, that's when it becomes long-term. A short-term capital gain, that is just taxed at your ordinary income tax rate, like any other income you may earn from your W-2 job or your 1099 or whatever it might be. But long-term capital gains, the government sees the fact that you held on to an investment for a year, and they've decided to give us a tax benefit when you hold on to it for that long. And that tax benefit is either that it may be taxed at 0% or 15%, and then there is a rate higher than that, but it's really rare to get up that high. But this bracket where you can earn 0% on your long-term capital gains is a fantastic place to make a whole lot of money for 0% taxes, and that's unheard of. You hardly ever pay 0% tax on money no matter where you put it. And now who doesn't want a 0% tax rate? If you would like a 0% tax rate, leave a comment down below and I would love to chit chat with you and see how you could use this in your own life, because everybody wants to pay 0% in taxes. And my wife and I, we were able to take advantage of this in 2024. We knew that our income was going to fall within that 0% range. So we harvested all of our long-term capital gains. And now, of course, the picture I'm painting may be all roses and rainbows, but it's not really that easy, right? There's always the emotional and behavioral aspects that come into personal finance. And even when it's a home run decision, like getting a 0% tax rate, we almost missed the chance to do this because we just didn't have the knowledge about this strategy until December of 2024. And then I was super grateful to learn about the strategy. I was super gung-ho, but my wife was a little nervous. She was like, will this actually work? Is 0% tax even legal? Is that allowed? How does this actually work? So it took a little bit of education for us to both feel confident that this strategy would work. And this was something that everyone can do, because I'm a lot more involved in the financial planning and the nitpicky, nerdy stuff of finance. I knew that this would work out for us, and I was able to teach my wife. And I'm going to teach you all today that this is something that every one of you can do. If you're considering selling some investments for a gain, make sure we have a conversation or you look up capital gains harvesting in more detail, because it can be a great strategy for you to pay 0% on that money that you've earned through the stock market. And it's a great strategy if you've been investing over the last few years and you're just getting ready to sell for the first time. And this is one area that you can figure out on your own, and it doesn't take a whole lot of complicated help. Let me explain a little bit of the things you can look for from my perspective. I've always used Fidelity for our investment account, but you'll log into your investment account and try to look at the specific, what they're called are lots for your investments. Look at the specific investments that you made on specific dates. It will tell you which ones are long-term and which ones are short-term, and it will tell you which ones have a gain and which ones have a loss. And I'm going to talk about how you can still benefit from that loss when it comes to your tax return later in one of the case studies today. But this is how you identify your opportunity. You look at which ones are long-term, which ones have a gain, and then you go and look at your income to make sure you fit within that 0% bracket for long-term capital gains. And I'm happy to help each one of you evaluate your own unique situation, because this is definitely something that's unique and something that you'll want to take advantage of before the end of the year. And I bet there are some of you listening who could benefit and take advantage right now of that 0% tax rate on your long-term capital gains. And this will also allow you to increase your basis if you reinvested the money into what you were already investing in. And I'll talk about that in more detail today in one of today's case studies as well. But what's the result of this? We were able to lock in a 0% tax rate on some of our money that's invested. Who wouldn't want to do that? The only other account that allows for 0% tax rates are Roth accounts on just growth and the HSA on everything. And speaking of HSAs, go check out episode 6 where I talked about the super powerful tool that is an HSA account. And you can get this 0% rate like I've been saying through this whole story. We were able to lock in about $300 worth of gains at that 0% tax rate, and it'll be tax-free forever because that now becomes the money that we've already invested. And gains and dividends are the only things that are taxed in a taxable brokerage account. And you may even have more than a few $100 that you could do this with. So make sure you're looking at your specific situation. I'll teach more about the specifics in this process in today's research segment and case studies, of course, so make sure you stick around. But really, it can be as simple as this. You know which tax bracket you fall in, you sell your long-term capital gains, then you can either use the money or simply just reinvest it right back into what you just sold. But know that you can do this, and there's a whole lot more awesome strategies that we're going to get into today when it comes to taxes. And taxes can be purposefully complicated and annoyingly complex by our government and the tax companies trying to lobby to keep it complex. But you can learn enough, and you can learn what you need to know to make some real opportunity become present for you in your tax situation. So now you might be thinking, that sounded great, Skylar, but what can I actually do about it? Well, with today's research segment, you're going to be able to come out of this podcast episode saying, I know enough to be dangerous about taxes. So your next tax return, you're going to be able to take advantage of some of these great opportunities. And I'm excited to share with all of you the research that I found for today's episode. Let's get into today's research, and I want to start off with just an explanation about how in the world do these tax brackets work. So what is a tax rate, marginal tax rate, effective tax rate? Well, a tax rate is a percentage of your income that the government claims for taxes, And without more detail, this phrase is mostly meaningless. There's a lot more that goes into tax rates. A marginal tax rate is the rate that you'll pay on your last or highest dollar of income. And your effective tax rate, this is the one to know, is the actual percentage of your gross income you pay once you've reduced your income with deductions and filed your taxes. This rate is generally much lower than your marginal tax rate. The effective rate, well, that's the real one that you're actually paying. Marginal is nothing more than the bucket that your last drop of income is flowing into. And the idea of thinking about these tax brackets as buckets is one that we're going to hit on a lot today because I think it's a much better way to view tax brackets. And the next thing about tax brackets is that it's helpful to think of these income ranges as falling into buckets rather than brackets. Each bucket holds a different amount of money that's taxed at a different rate. So when the first one fills up, your income spills over onto the next one and so on. And I do have an image on screen showing how this bucket idea works. So make sure you're watching the podcast on YouTube or Spotify if you want to see the video version. But of course, I'll make sure to explain everything for those of you listening on audio. Thank you so much for also tuning in. And now just know that nobody pays taxes on every single dollar of income. There's a bunch of different types of income and deductions and things that you can do to minimize your taxes. For example, your 401k reduces your taxable income because that money comes straight out of your salary. An HSA can lead to a deduction on your taxes. And then the standard deduction can reduce all of your income. So there's a lot of different ways that your money gets calculated before you get to your actual tax rate. And of course, this is where it can get seemingly complex. But when you really start getting into all the different areas of the tax code, that's when it gets really complex. The thing to know about 401k, IRA, or HSA deductions is that they don't have to be that complicated. Just know if it's traditional, it'll likely reduce your tax bill. If it's Roth, you're paying taxes on that money now. And then the HSA, of course, is the super powerful one that can both reduce your taxes now, never owe taxes on it going forward. So let's say you have $98,000 in income. You contribute $9,000 to a 401k and $3,000 to an HSA. And then you take the standard deduction of approximately $15,750, depending on what year you're looking at. Well, just those things alone could reduce your income to $72,250, down from $98,000. So if you do some math carefully, you can see that, oh, now I'm falling into the long-term capital gains bracket that I want to be in. Or I'm able to reduce it down into the 12% bracket. There's a lot of fun math that you can do once you begin to understand the tax formula a little bit. Some people think that if their income increases, then they're bumped into a higher tax bracket and they will pay taxes at a higher rate on all of their income. With this reasoning, some tax filers believe that they may have less money left over after getting a raise or if they would have earned less. This is just not true. I had an episode on my other podcast, Money Talk, where we busted this myth flat out. And now let's listen to that sound clip from my interview with Kyle on Money Talk to hear him answer the question about if people pay more taxes after they get a raise. Will someone end up making less money when they get a raise because their taxes are going to suddenly balloon?
That is a great question, a very common misconception. Just on Monday, I was meeting with some clients for the very first time. There's a doctor and his wife. First question out of the gate, she's like, I'm really concerned about my husband taking on additional shifts because it's going to push us into a different tax bracket. And what I was able to walk through with them was how we have a progressive tax system. Basically what that means is that you only will end up paying higher taxes on the portion of your income that kicks you into that next bracket.
And there you go, straight from a CPA. You'll never lose more money on what your raise is worth because of how marginal tax brackets work. Your money just keeps flowing over into the next bucket. It doesn't make all of your money retroactively taxed at a higher rate. And now you're probably wondering, what are those numbers that these brackets or buckets end up being? And so I'm going to put the 2026 tax tables up on screen here, and let's talk about them in a little bit more detail. So there's a single filers, married filing joint, and a head of household column on this chart. And so you'll see here, you go 10%, 12%, 22%. So let's look at it for the single filers. If you make over $12,400, then every dollar over that's going to be taxed at 12%. And then any dollar over $50,400 will be taxed at 22%. Any dollar over $105,700 will be taxed at 24%, and so on as you move up this chart. It's not that as soon as you make $105,701, all of your money before that is now taxed at 24%. It's only what goes over into the next bracket. So that's where the attention to detail lies. And I wanted to bring up the 2026 rates because that's going to allow you to plan going forward. Just know that today's case studies, those are going to use 2025's tax tables. They're only slightly different because each year it increases. They go up in order to keep pace with inflation and such. But I wanted to show you some research about what you can expect next year as you're beginning to plan your taxes for 2026. But let's take an example here of a single filer in 2026 who makes over $50,401. Every dollar over that $50,401 is taxed at 22% up to that next threshold like I talked about. And then every dollar so on keeps getting taxed at a higher rate. And now if you look at the married numbers, those tend to be about double for the brackets. So that allows both people to be working and still fall within that specific tax bracket. Now let's talk about capital gains. This is another tax bracket that is important to be aware of. Capital gains have a little bit of a different tax bracket because if you hold it for a year, like I mentioned, then it becomes long-term capital gains. If you are filing single, that 0% bracket goes up to $49,450. If you're married filing jointly, it goes up to $90,900. Now, this is where the story that I told about being able to fit your capital gains into that 0% bracket. Well, if you're married and make under $98,900 after the whole tax thing is calculated, well, then you can get that 0% rate of return on your gains. And now you're probably asking, what about those tax losses, Skylar? Didn't you mention that there's some benefit for tax losses? Yes, you can harvest losses for up to $3,000 against ordinary income on your tax return or against your capital gains. So this means if you have investment losses, it can help reduce your tax bill even further. And I have a case study prepared for you today that's going to walk you through exactly how this $3,000 limit and capital gain harvesting works. But this is also something that can be incredibly important to be aware of because maybe it would be really beneficial to do it this year and increase your basis for future years. And this is something that you could potentially take advantage of to get tax-free income easy peasy. It's something you can definitely take advantage of this year. But let's tie some of this together with how your taxes are actually calculated. What in the world is adjusted gross income, or AGI as you'll often see it abbreviated? The tax formula goes income from any source minus exclusions equals your gross income minus your above the line deductions like HSAs or traditional IRAs, etc. leads you to adjusted gross income. Then you get to below the line deductions like standard versus itemized, which we'll cover next. And that leads you to taxable income. So what in the world is AGI? Well, AGI is your gross income minus certain deductions as defined by the IRS. Some common ones include student loan interest, traditional IRA contributions, health savings account contributions, self-employed expenses, and some educator expenses for teachers. But what is taxable income? Well, this is calculated a little bit further down the line, but taxable income is the amount of your AGI that remains after subtracting out deductions and certain additional adjustments. Typically, this is your AGI minus the standard deduction, unless you have a reason to have more itemized deductions. But if you have more itemized deductions, then you choose the itemized adventure, and we'll talk about that next. But there's some strategies to reduce your AGI and taxable income because tax planning is most effective when you approach it in two stages. Lower your AGI first and then reduce your taxable income. You can do that by contributing to tax-advantaged accounts like a traditional 401k or a traditional IRA. You can contribute to an HSA, and be sure to check out episode 6 for some great tips on HSAs. But you also, if you're self-employed, half of the self-employed taxes or your health insurance premiums may be deductible. So that's just more things you need to consider. And of course, this all seems so complicated, but it really doesn't have to be. We just walked through how you get from gross income to adjusted gross income to taxable income. And you heard me mention the standard deduction. The standard deduction is one of those key pieces that reduces your taxable income. But some of you might have heard about itemized deductions and potentially itemizing all of these different things. You're probably wondering, should I be itemizing instead? Well, let's clear that up right now with this article from NerdWallet where it says itemized deductions are certain expenses allowed by the IRS that can decrease your taxable income. Some common itemized deductions include property taxes, mortgage interest, charitable contributions, but quick note here, don't be tricked into always thinking that you're donating just for the tax benefit. That shouldn't be the reason you're donating money, but you're not always getting a full tax benefit in the way you might think. There are limits to the percentage of your contribution that actually counts as a deduction against your AGI. So make sure you're being careful because it does take a lot of donating to actually get to the point where it's higher than the standard deduction. And the other thing to be aware of is unreimbursed medical expenses over 7.5% of your AGI. But listen to me here. For most of us, healthy young adults, you won't hit this threshold, but it's good to know that it exists in case you have a year where there's a major medical emergency. Just know in the back of your mind, there's some deduction when it comes to medical expenses, and then look it up when you actually need to remember it. Now, we've covered a wide array of things when it comes to tax planning, and I want to round us out with a great list of common mistakes that people might make when they're filing their taxes. I have even made one of these mistakes, so please don't feel bad if you're not perfect with filing your taxes. I have 7 common tax mistakes, and we're going to talk about a few of them in more detail, but 1 is failing to plan ahead. 2 is missing deadlines. 3 is neglecting quality control. 4 is missing credits or deductions. 5 is itemizing when standard is the better choice. 6 is inadequate records, and 7 is ignoring IRS notices. And I know all of this seems so cumbersome. Taxes are annoying, and the tax code is a huge headache, but this is the reality that we have to deal with and the reality that we get to plan with. So if you're making a solid income and want to take advantage of some more of this, you can figure this out on your own. Avoid those common tax mistakes that I just mentioned. And this is also something that a financial planner could easily help you plan around. So if you have questions, please reach out. But I want to talk about quality control because that's the one that hits home for me. Because guess what? I over-contributed to my IRA in 2024, which sucks because I did some of that in 2025 and I could have stopped myself. But there's going to be a bonus episode coming out once I figure out exactly how that's going to work out with my next tax return. And that'll probably come in May. So make sure you're subscribed to the show so you don't miss the bonus episode where I talk about the mistake that I made in over-contributing to my IRA. It's going to be one where I learn a whole lot and I'm happy to share it with each and every one of you so you can avoid it. Or if something like that does happen to you, you know how to solve it. The other common mistake is failing to plan ahead because you might have a tax advantage saving vehicle that you could be contributing to. And we'll talk about how you may still be able to contribute to it at the beginning of the year in one of today's case studies. There's capital gain or capital loss harvesting that you can take advantage of. There's making sure your withholdings on your paycheck are correct. And then company stock compensation. That's something that you have to be careful with. And if you have any questions, please reach out. But let me know if you're interested in trying to do one of these strategies either in 2025 or if you're listening to this in 2026 and you have time to really plan your taxes. Please reach out. I'd be happy to help you get your situation under control when it comes to taxes because they may seem really complicated, but honestly, they don't have to be that complicated. And if you do a little bit of planning around them, there is a wealth of opportunity that you can do with taxes. But now that you've got the foundational knowledge, you may be saying to yourself, okay, Skylar, this is all good, sounds cool, sounds good in theory, right? But how does this actually work in real life? That's exactly what we're going to cover next. I've created 5 mini case studies based on real life scenarios that people in your exact situations have faced. So let's see today how Emma, Marcus, Jordan, Aisha, David, and Maya used what we learned today to make smart tax moves. So let's get into today's first case study with Emma and the raise where she wondered, will I actually take home less money? This is a pretty common conundrum that most young adults find themselves in. Emma, she's 26 years old. She's a marketing coordinator, makes about $58,000 a year. She was offered a promotion up to $68,000 a year. She was very quickly super excited about this raise, right? But then a coworker mentioned the idea that you need to be careful because that raise might push you into a higher tax bracket and you'll actually end up making less money. So now Emma gets super nervous, right? Super worried that should I have declined the raise? That doesn't make any sense. At first glance, it seems like the $58,000 per year might actually already be in the 22% tax bracket if you were looking at the tax brackets on screen. But make sure you consider the standard deduction, among other things, of course. But for simplicity, we're just going to use the standard deduction in this case study. First, the 12% bracket is about $12,000 to about $48,000. And then the 22% bracket is about $48,000 to about $103,000 for single filers. So for the current situation for Emma's job, she makes $58,000 a year as her gross income. The standard deduction is $15,000. So her taxable income is $43,000. And see, that is where the 12% tax bracket applies. And this jump from 12% to 22% It can be such a common point of contention where you're like, whoa, am I suddenly paying so much more in taxes when I don't really want to be? Should I be making less money so I can avoid taxes? After the raise, with $68,000 as Emma's new salary, her gross income is $68,000. The standard deduction is $15,000. Her taxable income is $53,000. Now, only $48,475 of that is taxed at 12%, with some of it being taxed at 10% with that even lower tax bracket. So only $4,525, the difference in that new tax bracket, only that amount is taxed at 22%. So the reality of this whole situation, well, the first $48,475 of your income, my income, Emma's income in this case study is still taxed at 12% regardless of the raise, and there's still a portion taxed at 10%. All the dollars above the next tax bracket, that's what's taxed at 22%, 24%, and so on. So she's not going to lose money by getting a raise, despite what critics might say, right? She's still going to take home a lot more because of the raise. Now, if she were to even put some money into a 401k, she could reduce her taxes further. She could potentially get rid of all the income that's in the 22% bracket and put it into some sort of retirement account. But the key takeaway to this first case study is tax brackets, they're marginal. Think of them like those overflowing buckets. Let's stop calling them tax brackets and let's call them tax buckets from now on. And now Emma only barely started to fill up that 22% tax bucket, and the raise she got is actually going to help her. It's not going to hurt her tax-wise. But let's meet Marcus, who is actually able to pay 0% in taxes, just like my wife and I, with capital gains harvesting. Marcus is a 28-year-old, he's married, and him and his spouse filed jointly. Marcus earns $52K as a data analyst, while his wife earns $48K as a teacher. Their combined income is $100,000. How exciting is that? They started investing in index funds 3 years ago and have $25,000 in a taxable brokerage account that's now grown $7,000 up to $32,000. So now you're probably saying, isn't $100,000 over that taxable income bracket for 0% long-term capital gains, which is at $96,700? But don't forget the standard deduction, the things you can do to reduce your income. Because the standard deduction of $30,000 brings their taxable income down to $70,000, which is well within the 0% long-term capital gains threshold of $96,700. So you have to make sure you pay attention here, because here's the strategy behind all this. Make sure you've owned the stock for over 1 year so that it's considered long-term. And then in this situation, Marcus is planning to sell the $7,000 gain as long-term capital gains. He's going to pay 0% in taxes on it since they're within that 0% long-term capital gains bracket. And you have to make sure the gains don't put you over the threshold, or you may be taxed at 15%, which is still a pretty great tax rate, to be honest, but maybe you can wait to sell more investments next year and get it at 0%. So there's a little bit of planning that goes on with that, especially if you're close to the edge of that bracket. Now, the cool part with this strategy really begins to get awesome when you start thinking about raising your basis. Basis is how much you have paid into that investment. So let's say he sells the $7,000 gain. It gets locked in as tax-free, and now you buy the same index fund. Now in the future, you're only going to pay gains over that new basis that you just locked in. So previously, the basis was $25,000. You take the $7,000 gain, pay 0% taxes on it, and now you reinvest that into the same fund, and now your new basis is $32,000. So now let's say next year, you're up another $1,000 or whatever, right? You sell, and that $1,000 is all that is taxed. And so if their income continues to be within that 0% bracket, you could keep doing this every year and continue to climb that basis up with 0% taxes. Who doesn't love a tax-free win like this year after year? But one thing that we talked about is that if you're almost to that 15% threshold, this just needs to be a decision that you make. My wife and I, we're going to be close to that 15% threshold this year, so I may do some more specific math to see what we can do, to see if we can get some of those 0% capital gains. But we may also not worry about it this year because we have some potentially low tax years coming soon that I'm going to talk about in an upcoming episode about changes to your financial picture and how to deal with them. But everyone is unique. So if you're starting to get closer to different tax situations, that may be a good point to reach out and ask for help. But the key takeaways for this second case study are lock in that 0% long-term capital gains if you're within that bracket. And if you are within that bracket, you have to look into this strategy, because who doesn't want to pay 0% in taxes? If you want to, leave a comment down below. And remember, this strategy is called capital gains harvesting. So next time you're looking at your investments and you see something listed as long-term capital gains, consider harvesting those gains for 0% taxes. But of course, I keep saying we all love 0% taxes, but investing isn't always rainbows and upside. So how do you turn losses into another tax opportunity? Let's meet Jordan in our third case study and see how they used $2,100 in losses to reduce their taxes. Let's go over a little bit of background for Jordan and this third case study. Jordan's 29 years old, single, earning about $72,000. He started investing in 2024 and put $15,000 into a mix of index funds and individual stocks. Unfortunately, his hypothetical 2025 has been rough. The overall market in this scenario is down about 8%. The two individual tech stocks that he picked are down over 40% each. So maybe in this story, the AI bubble burst, right? But let's go over the numbers. The total portfolio started out at $15,000. His index fund was at $10,000. It's now at $9,200, so down $800. Tech stock A was at $2,500, is now worth $1,500, so down $1,000. Tech stock B started at $2,500, now worth $1,400, so it's down $1,100. The total value now is $12,100. He has losses of $2,900. And now he's beginning to say, well, maybe I need to get out of these individual stocks and just stick with a total market fund. And I may have to sell these at a loss because they're down pretty big. So he's going to end up selling tech stock A and tech stock B and realize that $2,100 loss. But he keeps the index fund because he believes in that long-term investing approach and that the market overall is going to recover. So he uses the $2,100 to buy more of the index fund that's also down because it's on sale. That's another great opportunity, even when your stocks are down. So here's where the tax opportunity for today's episode comes into play. Jordan can deduct that $2,100 loss against any capital gains this year. If he doesn't have capital gains, you can deduct the $2,100 against ordinary income. The IRS allows you to deduct up to $3,000 per year in capital losses to offset ordinary income. Since his loss was $2,100, he can deduct the full amount because it's within that $3,000 range. So within Jordan's 22% tax bracket, like the one we were talking about Emma potentially getting pushed up into, or the tax bracket you might be in, this deduction is going to save him approximately $462 in taxes. So there you have it. That's how selling investments, even at a loss, can still be beneficial. I do want to caution you here, though, with an important note about wash sale rules. Say it 5 times fast, it'll get really hard to say. But the wash sale means that you need to wait 30 days before buying back the stock that you sold at a loss. Now, the thing to be careful of is you need to be aware of 30 days before and after. You can buy a different investment within that time frame, but it can't be substantially identical according to the IRS, or else you can run afoul of wash sale rules. Wash sale rules disallow your loss and add your loss back into the basis when you repurchase. And you do have to be careful because it's 30 days before and 30 days after. So if you were to sell the stock at a loss and buy the same stock 10 days after, that is a wash sale and the loss is suspended. Like I mentioned, losses are added to the basis of your new stock purchase, which makes it harder to realize a gain because your basis needs to start out even higher. So here's some notes about wash sale rules from Fidelity. They say you can't use the loss of a sale to offset gains or reduce taxable income, but your loss is added to the cost basis of the new investment. The holding period for the investment you sold is also added to the holding period of the new investment. So in the long run, there may be upside to a higher cost basis. You may be able to realize a bigger loss when you sell your next investment, or if it goes up and you sell, you may owe less on the gain. So the thing to know here is that wash sales aren't all bad, but they're something you generally want to avoid. It pretty much just takes that loss and makes it so that you can't recognize it right now because you bought back too soon. So the key takeaway here is that with capital losses, you can offset up to $3,000 worth of ordinary income, which can reduce your tax bill and could be an opportunity for you to get out of an investment. If you have more than $3,000, you can carry it forward into future years. So you can use your losses to reduce your tax bill, but you can also control your tax bill with 401k contributions. Aisha's story next is going to walk us through just how you can do that with a 401k. Some background about Aisha. She's 27 years old, single, makes $65,000, just started what she calls her first real job, and she's been contributing 3% to her employer's 401k to get the company match, which is a common situation we all find ourselves in at one point. But she's been reading about taxes, and frankly, Aisha could be doing even more with potentially saving some money on taxes. So I mentioned her gross income, $65,000. She's putting 3% or $1,950 into her 401k. The standard deduction, which we always need to consider, is $15,000, making her taxable income $48,050. So Aisha, here she is. She's starting to recognize that these traditional 401k contributions, they're reducing her taxable income. So she decides to increase it to 10%. How does that impact her retirement and current income situation? Well, of course, it's going to help her save for retirement even faster. But it lowers her current tax bill down to $43,500 because she's contributing even more to her 401k, which is directly reducing her taxable income. So the tax savings overall helps keep more of her income in just that 12% bracket and avoids pouring over into that 22% tax bucket. And the tax saved on the additional contribution is about $501. Her take-home pay decreases only slightly of about $350 a month, but she's now putting away an extra $542 per month towards retirement. So this trade-off, it is far worth it. She's reducing her taxes now. She's putting away more for retirement. There's a lot of opportunity with a 401k when it comes to putting money away to both reduce your taxable income now and save for the future. So the key takeaways with Aisha's story is that traditional 401k contributions, they reduce your taxable income, which means you pay less taxes today while building wealth for the future. The 401k is one of the easiest and most powerful tax planning tools available. Aisha now, like you should, is going to go out and tell her friends that the 401k is such this awesome tax vehicle, right? Just like you're going to share this episode with a friend and tell them all about how you learned about taxes and how taxes were finally fun to talk about. So make sure you're sharing your knowledge as you learn these things with other people so that we can all do better with money together. And now, are you getting ready to file your taxes and realize that you may owe some money? The number at the top of the screen says you owe a few $100. Well, our next case study with David and Maya, they're going to show us exactly how they turned a surprise bill into a welcome refund with their HSA and IRA. David and Maya, they're 30 years and 29 years old. They're married filing jointly. David earns $58,000 as a teacher and Maya earns $54,000 as a nurse. Their combined income is $112,000. They were doing their taxes and they realized they owed a little bit more than they expected. They, just like so many other people, really have no idea how to file their taxes throughout the year with the withholdings and whatever else you need to do, right? Especially when you start working multiple jobs or there's multiple income earners in the household, it can get a little confusing. How much do you actually withhold from taxes? Shouldn't the government do it properly? Shouldn't my employer know this number, right? And then you're left there at the end of the year feeling sad, frustrated, and annoyed that you owe money to the government. Well, there's a couple strategies here that can help you flip that on its head so that you get a refund. Maya, in this situation, didn't realize that she was on an HSA eligible health plan all of the previous year. So she was actually able to contribute to the HSA up until the tax filing deadline because she was eligible for the entire last year. So they decided to put $3,000 into Maya's HSA. This reduced their taxable income by $3,000. David opened a traditional IRA and contributed $3,000 as well. Both the HSA and the IRA are great vehicles that allow you to contribute up until the tax filing deadline. There's no extension on this, but up until the tax filing deadline, typically April 15th of the next year. So if your tax situation isn't quite what you want and you're owing a little bit of money, there could be an opportunity to put some money away, either for your health care or for your future retirement, and be able to flip the script with your tax return and make it a refund instead of a bill. So the total reduction for David and Maya was $6,000 on their taxable income. At their 22% tax bracket, that was $1,320 worth of tax savings in 2025. And now instead of owing money, they're probably going to get a refund. This is an exact walkthrough of what my wife and I did years ago. We were able to get our tax bill down and went from owing a few $100 to getting more than a few $100 back. And it makes it easy to think of it in that light because you can just say, well, I'm putting my return into my HSA ahead of time so that I don't owe money to the IRS. There's some awesome opportunities here, and you have until the tax filing deadline to make HSA or IRA contributions that count for the previous year. And this can give you a chance to catch up on last minute contributions. So you can control your tax bill right before you file up until that tax filing deadline. So if you owe money, flip it around and make it so the IRS owes you money. That's such an awesome way to use these tools, and it honestly feels so empowering and exciting. Once you get to that point where you're able to control your tax situation, it really feels like you're sticking it to the IRS, which is just a fun thing to do, right? So if you owe, use this strategy to flip it on its head and get yourself a refund. That does it for today's case studies, research segment, and story. We're heading towards the end of the episode here. Let me know down in the comments what you thought, and I'm going to wrap it all up next. As we wrap up here, please subscribe wherever you're listening to the podcast. We're seeing a lot of great growth right here out of the gate, and I want to keep that momentum up. So if you know someone who just got a raise or might be filing their taxes soon, which is all of us, share this episode with them. It could help them save hundreds of dollars. Today's main action item is to review your tax situation and see which strategy you can implement before filing your taxes. And I hope everyone enjoyed what we were able to cover today. From my story about how we locked in a 0% tax rate on some investment gains, to all the research about all the different tax tables, understanding how taxes are calculated, itemized and standard deductions, and some common tax pitfalls that people find themselves wrapped up in with their taxes. I think we had some great lessons in this episode today, and I hope you enjoyed the return of case studies. And I broke it down into a few mini case studies, so let me know what you think about that approach. Leave a comment down below about what you thought about today's case studies. If you enjoyed the return to case studies, please let me know. I'd love to hear just more and more feedback as we get this show going about what you liked or didn't like, so I can tailor this to what suits my audience best. And the next episode, it's going to be a great one, all about your life changing and how you manage money through all those different situations. And I have some exciting and big news to announce next week that has to go along with how my wife and I's life is changing. So there's going to be a very recent story in next week's episode. So make sure to subscribe, because that does it for this installment of Financial Planning for Young Adults. I hope I was able to make the seemingly complex world of financial planning a little clearer for each of my fellow money buddies today. I'm your host, Skylar Fleming. Have a great week. And hey, quick heads up. This podcast, it's meant to be educational and it's for entertainment purposes. It's not personalized financial advice for your specific situation. So before you go out and make any big money moves, make sure you chat with a qualified financial professional who knows your full financial picture.